Moving on to 6.7 on 9:20 a.m., consideration of December 31st, 2023 report of Lake County pooled investments. And we have our folks for this item coming up. Good morning.
Good morning. Thank you for the opportunity to present this today. Patrick Sullivan, Treasurer Tax Collector. I'm here with Carlos Oblitas from Chandler Asset Management. We're aware you guys have a long agenda today, so we'll try to skip to the highlights and run through the presentation.
Well, it's all good news. Let's start with that. So rates continue to be high. Remember that you have a bond portfolio as allowed by California government code. The way that you generate return for your portfolio is two ways. Number one, primarily interest income that you earn. A bond is a loan and you charge interest on that loan, you get paid for that. That's higher than it was a year ago. It's significantly higher and looking really good. The second component, of course, is the principal can go up and down in value. And that value is generally on paper. Sometimes we realize it by a sale before maturity, other times not. We didn't this quarter. There's a strategy in place. It's a long-term strategy. It generally maintains a weighted average maturity and duration within a range. But ultimately, the portfolio is looking good because it's very well diversified, it's very liquid, and the income, the interest income that you're receiving from it continues to be strong. I want to remind everyone, there are three components to the portfolio. There is a component that the Treasury manages in-house, primarily through the use of local government investment pools and the state pool, local agency investment fund, LAIF. There is a core portfolio that we collaborate with the Treasurer Tax Collector to manage, which is the larger component of the investment program. And then there's, of course, a small side portfolio that the Treasury, your Treasurer Tax Collector, collaborated with us to set up for some of its shortest cash to take advantage of an anomaly in interest rates right now to capture some higher yields for that. It's a temporary portfolio. We don't anticipate that it'll be around forever, but for now, it's filled its purpose. With that, let's turn over to page number 25. I want to talk about the core portfolio that we manage. That's valued at around almost $372 million. Currently, the yield to maturity on that portfolio is 2.86. The yield to maturity is the interest income that you are anticipated to earn on an annual basis if nothing in this portfolio changes. That's up from 2.54. And the reason that it continues to grow is because if you look at the market yield, it's the fourth row down from the top. The reinvestment currently is at 4.72. That market yield is the yield that you would get for these securities had you purchased it on the date of this report, which was December. And if we have money that matures, or if we have new money in the Treasury, and invest it to this strategy, that's generally the yield that we will pick up. So it infers a reinvestment rate. A little lower than what it was 3 months prior, September 30th, and that's because interest rates were on their way down. I'm going to talk about that in a moment. That's the core portfolio. To give you an idea, the returns on that portfolio, you don't have it on here, but that's something that we do report regularly, in fact, every month to your Treasurer Tax Collector. The return for the year on that portfolio was 4.78%, and I would estimate that somewhere around 2.25% was just interest income alone. So a very strong quarter, very strong year, very strong calendar year, and also the last 3 months of the year were very strong. That return was 2.39, and I would say that about probably 55% of that was interest income alone. If you annualize that number, that 2.39 number, just for those last 3 months of the year, the annual equivalent of that is over 10% return. So in the bond markets, that's a really, really good return. So you're doing well. If we go to page number 26, I think, you can see that yield to maturity just continues to grow and grow and grow. That is a function of two things. First, of course, that there are higher yields available in the market. It costs more money for corporate America to finance itself. It costs more money for the United States government to finance itself because interest rates are much higher. Those interest rates are higher because the Federal Reserve has worked to make it more expensive to borrow in order to cut people off from access to cheap credit, to drive prices down. They've been trying to combat inflation, and we've talked about that in various other meetings. But for that reason, that cost to borrow money is higher. You're a lender, the return to you is higher. The other thing that I think I want to highlight is, and we're going to keep it very brief here, I'm just going to select slides here. Rates since the end of the year have come down. In fact, they started coming down sometime in September. The reason for that is because investors believe that the Federal Reserve is ready to start lowering interest rates. A lot of investors believed that the Federal Reserve overdid it. They raised rates to a level that's unsustainable, and eventually they're going to be forced to lower interest rates. Otherwise, if they cut off that access to cheap credit too much, the economy will stall. So they have to sort of rebalance that by bringing rates down. When you look at Fed funds futures, those are futures contracts that we can look at where investors are basically hedging what they think the rate is going to be into the future. It implies a rate. The probability of that rate being lower in March was something like 87%. Since that time, in early February, we've had some events, some news in the economy that tell us that the economy continues to be strong, and perhaps the Federal Reserve does not need to start lowering interest rates as quickly as everyone thinks. That 87% probability of a lower rate changed to about 17%. So you can see things are definitely shifting. We think that the Federal Reserve is going to keep rates at the levels that they are for a longer period of time. We don't think they're going to lower rates until sometime later in the second half of 2024. That means for you that this portfolio will continue to pick up higher yields and will continue to provide higher interest income and will continue to provide the pool participants with higher apportionments, and that's good news. If the rates start to fall, the value of everything on paper will go up, but of course the reinvestment will be lower. If you look at page 27, this is the liquidity portfolio. This is that short-term portfolio that we talked about. Your Treasurer Tax Collector jumped on it, took advantage of an anomaly in the bond markets, and that anomaly is that short-term rates right now, shorter, when I say shorter, I mean less than a year, those yields are significantly higher than longer bonds. And he was able to, just working with us, we were able to build a portfolio. This one's valued around $52 million, where we're picking up almost 5.5% on these investments. That's not going to last forever. That's going to go away. It's already going away. But while it's here, we took advantage of it, and that's to the benefit of the county. The other portfolio is the state pool, and do we have that? That's actually going to be page 34. So this is a combination of investments in the state pool, local agency investment fund, LAIF, also some local government investment pools that the Treasury maintains, and also the money market sweep. One of the things that your treasurer did was get back to the bank. There's a significant amount of money that the Treasury maintains at your bank account to be able to pay checks, to make payroll, to make money available to participants in the pool. Well, that money has to earn something. He was able to negotiate the use of a money market mutual fund at the bank, which is paying you a significantly higher rate. So something similar to the portfolio, that smaller portfolio that we're running right now. So you're trying to earn every which way. We're turning over every rock to be able to earn some money. I will tell you that going forward, rates are anticipated to be lower, as I mentioned, likely sometime later in the second half of the year. That's going to be driven by economic news. Right now, the economic news are stronger than anybody anticipated. For the month of January, we generated somewhere around 335,000 jobs. Only 185 were anticipated. So that just blew the hinges off, or the door off the hinges on the jobs number. It tells you that there's strength of the jobs market. GDP for the year ended up somewhere, for 2023, gross domestic product, that's the way that we measure the growth of the economy, ended up somewhere around 3.15, 3.2%. That's considered strong growth in the United States. Inflation numbers, though still headed in the right direction, still coming down, are still elevated. It just means that there's enough economic activity and enough growth in the economy to where the Fed, though they have no more reasons to raise rates anymore, they can wait to sort of wait and see before they start lowering interest rates. It isn't just that. They've given interviews. Jay Powell, the Fed chair, had an interview with 60 Minutes about 3 weeks ago on Sunday, like the first Sunday of the month, where he basically said, we're going to wait and see. We're not going to move immediately. So what does it mean to you? It means that you'll continue earning in a similar fashion. The value of these investments has gone up because rates did fall from September through December, and they fell a little bit in January. They came a little bit back up, but still within range. So we we don't anticipate any big shifts. I think I might end with the pie chart for the big portfolio because I think it's important to show that. Page 19, this is a very well diversified portfolio. This is the main portfolio, the $370 million portfolio. Primarily comprises of treasuries and agencies. Treasuries are loans to the federal government. Federal agency bonds are loans to its federal agencies like Federal National Mortgage Association, Federal Home Loan Mortgage Corporation. You know them as Fannie Mae and Freddie Mac. They help move things along in the housing market. But these bonds are direct obligations of these agencies. There's an implied backing for federal agencies from the federal government. There's a direct and explicit backing for treasuries. So those tend to be the safest and lowest risk. We do loan to corporate America. We loan to, we buy bonds from very high quality issuers. Some of those issuers, I'll just give you some names that you'll be familiar with. John Deere, Microsoft, Home Depot, Amazon.com, Caterpillar, Honda, U.S. Bancorp, and many, many others. Very high credit quality, widely held, in high demand. And we monitor all the credits to make sure that we don't have any sort of credit problems in that sector. That's it in a nutshell. I think looking forward, look out for the shift in rates and sort of the tenor of what the Federal Reserve is thinking.
Thank you very much for your presentation. All good news, as you said. Supervisor Pyska.
It's always a delight when you come, Carlos.
It's always a delight to be here.
So I'm glad you have it on this slide. I was going to ask about this because this, a lot of people haven't been following along with what we've been doing. And so if you scroll down a little bit, you can see where we started before we met you and before we built this investment strategy. And this is where we are. And then it looks like we just took a little bit of a dip at this last quarter, and I was just hoping you could explain that, what that looks like, and then what the strategy is going forward when the interest rates start to adjust more.
Absolutely. So I want to just take a step back and take the 40,000-foot view. So what the county did is they formed an ad hoc committee that worked with the Treasury and the former Treasurer tax collector. So there were supervisors, Supervisor Sabate, Supervisor Pyska, both of you were part of that committee. Your current Treasurer tax collector, Patrick Sullivan, was part of that committee. Some of the staff from the Treasury were part of that committee. Barbara Ringen was part of that committee. And collectively, we worked together to set a new direction for the portfolio. The CAO's office was involved in part of that. So there were a lot of hands in that process. But the idea was to, number one, get a handle on how much money the county had. Number two, form fences and parameters around how the investment program was going to be managed. Number three, start diversifying and investing in this portfolio to optimize it for return. Out of that process, the county came out with a new investment policy statement. Out of that process, the county came out with a new strategy for the investments and a way to easily track the accounting so that the Treasury would be able to easily book all the earnings, and then a way to be able to inform stakeholders such as the Board of Supervisors, the public, and understand what exactly is going on in the portfolio. So all those four goals were met. Through that process, interest rates rose. We like higher rates. It lets us earn a little more. That's why you see the growth in the investment. The dip right there, I think,
we're still trending upwards in terms of growth, but a lot of it has to do with timing for the different maturities when we receive the actual interest payments from the instruments that we hold. So I think while you're going to overall for the next year see growth, it's possible from quarter to quarter that we're going to see a small decline and realize those gains later.
If I may, the earnings, so the way that the Treasury books their earnings is they look at actual cash received. If the cash has not yet been received, it doesn't get booked, and that's part of that is because they base the apportionment rate to the participants, that apportionment rate that gets paid out, they base it on the cash number. They want to have the cash available. From an earnings perspective, though, there are earnings in the portfolio which you have earned, you just haven't received. That's called an accrual. So this doesn't capture the accrual because the Treasury is more interested in the actual dollars that they can pay out on. From an accrual basis, this is like a hockey stick. It's just upward moving.
Yep. Thank you.
Supervisor Green?
Yeah, thank you. On the pie chart on page 19 of the PowerPoint, actually page 20 of the PDF, we went from a 0% stake in the local government investment pool to a 5.5% stake. And we also had a drop in treasuries roughly equivalent to that. So can you just highlight that transaction?
Yeah, I can speak to that. We expanded our use of local government pools. They're a really valuable tool that we haven't previously taken advantage of. While we used LAIF in the past, there's other JPAs that do, it's a similar concept, but they invest their pool funds in the same way that we do. And they were better able to take advantage of the rate increases. So we always had an account at camp, but we used to keep about $8,000 in there. We bumped that up to $10 million. We use CalTrust, which is another JPA. We have about $20 million there now, and they're bound by the same rules we are. Each of them have various government agencies involved, and by using them, we get better liquidity. We're able to pull funds easily out or transfer them in. And so it's certainly been a benefit to us. You see cash, that's everything in the money market sweep. I just want to highlight again that we don't actually hold straight cash in an account, like in a checking or savings account where we're not earning a return. But yes, the expansion of the government pools, that is money that's not necessarily going. Previously, we probably would have purchased treasuries with those. By putting them in the pools, it buffers our liquidity.
And I can also add to that, Supervisor Green. So these local government investment pools are very short-term investments. So over the long run, they don't provide as much yield as the core portfolio that you have. But if you remember, I said that there's a component, a second component that we built. It was a side portfolio where we bought very short-term securities. And that's where we were getting the 5.48%. The reason that we were able to do that temporarily is because there's an anomaly in the yield curve in the bond markets. If we actually go to page 13, I think we'll be able to see it here. So that anomaly has allowed those local government investment pools to very quickly, because they're so short, they have more maturities coming in due faster. They can then turn around and reinvest that in short-term bonds to get a higher yield. It's the same concept that we're doing in that side portfolio. It's just that the Treasury's taken a diversified approach to this. They're doing this not just with the side portfolio, but they're also doing it with these short-term pools that give them same-day liquidity. So if we look at page number 13, now we're getting a little technical. I promise to keep it simple. The chart on the right-hand side is called the U.S. Treasury yield curve. What we're just simply looking at are Treasury bonds in different maturities from 3 months out to 30 years. And we're looking at what they yield, what kind of interest income on an annual basis they provide on a given day. You have 3 lines there. Those are 3 different days. And normally that curve, we use that curve because U.S. Treasury bonds are considered the safest investment. All of their bonds are going to have some sort of spread. They're going to pay a little bit more yield depending on their credit quality. And of course, the longer you get, the more time that you're leaving money invested, the more you should expect to get paid for that because there's more time for things to go wrong. So normally this curve is positively shaped. And what I mean with that is that the left-hand side of that curve, the 3-month, 6-month, 2-year, those yields are lower. It's lower, and the right-hand side is higher because you should expect to get paid more for locking your money up for longer periods of time. But it isn't. It's inverted. And that inversion of the yield curve is an anomaly. It's driven by 2 major economic forces. One is technical. I won't get into it, but the other one is the Federal Reserve moved very quickly. And when the Federal Reserve moved to raise rates, in fact, you can see that on the prior page, the chart on the right-hand side. It's that hockey stick on the right-hand side. This is the Fed funds rate. That's the rate that the Federal Reserve controls. And they move very quickly to raise rates to combat inflation. But if we go back to that inverted yield curve, that caused the shorter side, the short-term side of that curve to move higher than the longer end. And for that anomaly has allowed us to capture higher yields in the side portfolio. It's also allowing the local government investment pools to pay you higher yield. It's also allowing the sweep vehicle at the bank, which the Treasury took advantage of, to pay you a higher yield. But as I stated earlier, that is going away. That's an anomaly. There are some macroeconomic reasons why this will eventually go away. But while it's here, the Treasury's taken advantage of it. And we're going to ride that until the ride's over.
Thank you for that very technical answer to my question. I appreciate. This is a very short question. So on the pie chart again, just refresh my memory. ABS and CMO. What are those acronyms?
ABS is asset-backed securities. They are pools of receivables. CMOs are collateralized mortgage obligations. They're also a pool of receivables, but made up of mortgages. So it works like this. Toyota Motor Credit.
I don't need to know how it works.
You got it.
Maybe we could just maybe we could just add them to the legend somewhere. Thank you.
Appreciate the presentation. I know that I walked away from our first conversation together saying this guy knows things about money that I've never even thought of. But I appreciate the outcomes are exactly what we're looking for. This is why we're hiring you to do this for us and to take a look at our money. What I want to know is, this is something that I did have a conversation with Mr. Sullivan, and I want to bring it to the board to see if this is possible. We're very much looking at the oversight of the entire pool, but the entire pool is not just our money. And I think it would be good to understand what is our money and what is other people's money. And if we can break that down, maybe not on a quarterly basis, but at least on a biannual or annual basis, and what did each school district receive from this investment pool that we're doing? What did each of the fire districts receive? Just so we can break it down, so we can understand the benefits to all of the other agencies in our communities that are part of the investment pool, and to understand really what is our benefit, because it's not the 3.6 or 3.4, that's the overall for everybody, and then it gets apportioned to those individual agencies. So I'd love to see that in the future, just so that we can have a better understanding of our personal benefits and the community's benefits, so that we can have conversations with those agencies to let them know, let them be aware, and just be to engage in understanding what their benefits are with the changes that we've made, because this is not just the county of Lake, this is Lake County as a whole. So that's just something that I think would be beneficial for all of us to have that information. And I think there's agreement on the board for that to happen.
Annually?
Yeah, we could do it annually. Our system is capable of doing that reporting, so it's not really a significant burden. And just for rule of thumb, a little over half generally is to the county. The other half is everybody else, but a large block of that is schools, but just for the ballpark.
But I think most importantly is that this is happening now for them as well. So whereas it wasn't, and so it's a good move. Thank you for putting this together. Thank you for the work. And yeah.
Are there any other questions before I open up for the public? And anyone in the public have questions? Please come on up to the microphone.
My name's Lenore Stano, niece. Our streets are falling apart. I mean, is there a pool for, like, we could set aside for our streets or do some grants for our streets?
And so
If
that-
our streets are just crumbling.
I appreciate the comment. That would be a separate conversation, and
Okay.
some of that money does go into our general fund, and at that point, that would be during our budget items that we can discuss how it is that we allocate those funds. But thank you for the comment.
Okay, thank you.
Anyone else? I see no hands on Zoom, no one coming to the mic. Thank you very much for your presentation. Please keep making us money.
Thank you. Thank you.
Mr. Chair.
Yes.
Only because on the memo itself, there is a recommended action for
Oh.
accepting the report, so it would just be by motion if your board wishes to do so.
Thank you very much for catching that. I apologize for not seeing that. Bring it back here for the board for action.
Move that we accept the December 31st, 2023 report of the Lake County Pooled Investments.
Second.
We have a motion and a second. All in favor?
Aye.
Aye. Any opposed? Motion passes.
Thank you.
Thank you.